details provide actual data with only the client names that are changed. While some of the assumptions, the outcomes are displayed, the actual work product itself cannot be shared until such time as we're engaged by you for our services. In case study number 1, we have John and Linda. In their outcome, we were able to cut their income tax bill by over 30%. For the background, John is age 66. He's still working and he plans to retire at age 70. Linda is 61 and she's recently retired. They have a combined $520,000 in IRAs and they have rental property that they're selling and they expect to realize $175,000 of proceeds from, net of income taxes. In addition to the IRA and the real estate for sale, they also have another $68,000 in taxable accounts. All of our plans include cash flow needs, which are annually inconsistent, as we never really spend the same amount each and every year. We factor in inflation, which can vary for each category of spending. The earnings and inflation assumptions used in our plans are agreed to by the client. The household budget for health insurance for this couple until Linda reaches age 65 is $13,200 a year. Effectively, that amount would adjust down at Linda's Medicare age of 65, but because of inflation, it doesn't appear to on our plan. This is a modest couple with a paid-off house, believing that they need $45,500 a year to live on, plus another $3,600 a year for travel. They prefer to use a 3.25% inflation rate. The travel for them will stop after 20 years. Other than lifestyle, healthcare, and travel for the 20 years, the only other budgetary need is a new vehicle in the house. Every 5 years they plan to trade in a car, the next one being in 2020, and they expect to pay $15,000 in today's dollars over and above their trade-in value every 5 years, also using a 3.25% inflation rate. On their investment accounts, they desire to use a 7% average earnings rate on IRAs and Roth IRAs, and a slightly lower 6% rate on taxable investment accounts. It's not unusual to use a slightly lower rate on taxable accounts because they tend to be invested slightly more conservatively. To help offset their budgetary needs at the age of 70, using a 2.5% inflation rate, John is expecting $39,000 a year of Social Security income. However, based on our recommendation, he'll be able to file a spousal benefit beginning in August of 2019 and collect $1,248 a month and still collect his deferral credits on his own benefit until the age of 70. This is because his wife will be 62 at that time and she'll collect her benefit of $28,840 a year. Because he was born before January of 1954, he's eligible to file a spousal restricted application and still collect deferral credits on his own Social Security income. So we made the recommendation that he do that. Over the next 20 years, our recommended strategies would save John and Linda just shy of $70,000 in income taxes. In fairness, more of the taxes are being paid up front and less later. So in fairness, we should indeed question how this upfront payment of taxes impacts his wealth. This is indeed a large portion of our analysis as well, but just as important as growth wealth, we also need to analyze net wealth. By net wealth, we're referencing not just the amount in the IRA accounts that you get to see on your statement, but in reality, the amount of money that's yours after paying off the mortgage or the indebtedness to the IRS on that account. To analyze that, we need to assume a certain portion of the IRA will be lost funds to income taxes, either by you at some point or by your heirs. At the end of the 20 years, by following our proposed strategies in such a way that the client's gross wealth would have decreased by approximately $42,000, and their net wealth would have increased by approximately $200,000. There are probably two better ways to phrase this. Number one, would you give up $950,000 in your IRAs, which would be subject to tax on distribution and subject to required minimum distribution, and also give up $750,000 in taxable accounts, where the growth is taxed each and every year, to wind up with $1.65 million in a Roth account, never to be taxed again? I truly hope it's a rhetorical question, because I certainly would make that trade-off. Here's a second way to phrase the question. This portion of our details is perhaps the most telling. The top 5 rows is evaluating data on a gross basis, and the bottom 5 on a net basis. If we compare current versus proposed, in the proposed plan we would have lost $751,000 in the taxable account, and we would have lost $957,000 in the IRA on a gross basis, for a total loss of those two accounts of roughly $1.7 million in wealth. However, in the proposed plan, we would have gained over $1.6 million of wealth in the IRA. That effectively means that we were able to transfer 97.5% of our gross wealth from the IRA and the taxable account into the Roth IRA, meaning that our cost of the transfer, net of the tax implications, was 2.5% after 20 years. So if I suggested to you that you could realign your wealth into a Roth IRA, and after 20 years the cost was 2.5%, would that be attractive to you? That's probably the better way to put it. Now, if we did the same review, and if we looked at it on a net wealth basis, meaning that we assume that you own 75% of your IRA, and we assume that Uncle Sam owns 25% of your IRA, that being the mortgage portion of the IRA. If we use that assumption and your IRA value declined by 75% because of the mortgage, so that your net wealth, you really only lost, you lost $1.4 million of wealth between your taxable account and the net wealth loss of your IRA. And you wound up with $1.6 million in your Roth IRA, so that the Roth IRA represented 117% of the net value decline in those other accounts. So in essence, the government paid you 17% to prepay the mortgage. Would that be attractive to you? Of course it would. Notice also for this couple, we did leave some IRA monies, and we didn't recommend a Roth conversion of 100% of the IRA. In some cases, we don't recommend a Roth conversion of 100% of the IRA. The reason being is because we're now able to take required minimum distributions out of what's left in the IRA and do so at a zero tax bracket. At the end of the 20 years, for this couple, we still have $176,000 left in IRAs. And they're still in a zero tax bracket at this point. After 20 years, they pay zero taxes for the rest of their life. So that's why we didn't recommend Roth conversion of 100% of the assets. They got a tax deduction when they contribute it. They pay taxes on the Roth conversion, but they're not paying any taxes at all on the balance that remains in the IRA while they're taking their distributions during their lifetime. Lastly, let's look at the evaluation for their heirs. Since the heirs can stretch the IRAs and Roth IRAs under current law, and I must be completely honest, there's a bill that passed the House that will restrict stretch distributions to 10 years. It hasn't yet gotten to the Senate, but it has passed the House, so we'll see what happens to that. But under current laws, heirs or non-spousal heirs can stretch IRAs and Roth IRAs over their lifetime. So if we make that assumption and we assume that the distribution period for the heirs are 36 years in this particular example, the value of the stretch to the heirs, assuming a certain rate of return in column A versus a certain rate of return, that same rate of return over column B, the value over the 36 years of the A column is $14 million to the heirs, and the value of the B column over the 36-year distribution period is $28 million, which is a 100% increase in wealth. So when you call in, we'd be happy to demonstrate that to you and show you how the stretch laws can benefit your heirs as well. So please schedule a call with the tax planners now and let us discover ways to maximize your net wealth through our strategic tax planning. With our money-back guarantee, what do you have to lose? So please start your advanced financial freedom plan with us today. And I'm going to wrap up this presentation with a few myths. Myth number 1, taxes do not have a dramatic impact on wealth. Well, I think we've demonstrated that they indeed do. Myth number 2, there is nothing I can do about income taxes. Well, the truth is absolutely positively, there is something that you can do about income taxes, and that's why we're here. Myth number 3, I'll be in a lower tax bracket in retirement. When you start considering the double taxation that many receive in retirement, not for most of the people that we meet, they're not in a lower tax bracket, especially when you consider again that double taxation. And myth number 4, save in your 401k. Actually, we do encourage you to teach your children that they might want to save in their 401k, but they might want to also have an advanced financial freedom plan when they start hitting their mid to late 50s so that they can take control of their taxes when they hit retirement. They can learn how to turn the table on the IRS before it becomes too late for them. So lastly, please give us a call and let us help you discover ways that we can help you with your planning today. Thank you very much.